So I'm going to go ahead and get us kicked off. We're a couple minutes after the 9 a.m. hour. Appreciate everyone joining us for the Women in Wealth first event that we're having for the Speaker Enrichment Series globally. And the way this started, Women in Digital has been around for a couple of years within ISG, and a lot of our programs within Women in Digital touch internally and externally with our clients, with our partners, with people we met like at Private Vista. So the purpose of the Speaker Enrichment Series is really to think about what we want internally for our women around the globe. We took on a tough topic to start this journey, right? It's around women and wealth and how do we think about money. And the way this came about really started with the group coming together with Women in Digital and saying, well, what do we need that we don't have today? And how can we use our own networking capabilities to do that? So Sandra Williams in our banking and financial industry had met Stephanie, who you'll meet today. And over the last few months, we've put together a presentation for the ladies within the Women in Digital group, just to really think about finances in a different way. So we're going to go through the next 45 minutes or so with a presentation. There's going to be a few quizzes that we'll do. I think there are 4 total. So have your computers ready so you can vote and see the responses. There will be questions at the end. So with this tool, we are using the Zoom technology, not our internal Teams technology. So we can't ask questions that way. So if you can save your questions, you can either send them to Stephanie, who I'll introduce in a moment, via email, or we will have time at the end where if you can raise your hand, you'll be able to ask a question. So so in saying that, welcome, right, to Private Vista's, they've done a whole lot of work on women in wealth and how to own your own financial future. So next slide, please. And as we think about like women and the way that we think about money, the way this came about when we were talking in the Women in Digital group is that we all had different experiences, right? We were in different places in our life. Some of us were starting, just out of college, starting our careers, having children. Some of us are ready to retire. Some of us are in the middle and trying to figure out, well, what do we do now that our children are in college and they're no longer in our homes? So thinking about being strong in finance is not something that was apparent to a lot of us. For me, for instance, my husband is a math guy. So he sits down with me 4 times a year. We go through his Dave Ramsey plan. He gives me a lot of details that aren't important to me because they're not about stories or about numbers in an Excel spreadsheet. So for me, this was a passion project, and we're so lucky to have Kimberly Tobias, who runs our Women in Digital group, and then Kathy Rudy is our executive sponsor, Kara Degali, who has helped us along the journey. When you take something this specific, it takes a team to pull this off. So appreciate that. And what we're going to go through today, if you can go to the next slide, Nicole, is really, we're going to do some audience polls, right? So I think some of these things will shock you the way they shocked me. And then we're going to go through what are the different triggers. Is it the behavioral way that you react? Is it the life stages that you're in that I just mentioned? Or the financial literacy track, which really has more to do with the numbers and pieces and parts about where you put your money. And then at the end, we'll do the Q&A piece of this. So looking forward to the next 45 minutes and excited about what you all are going to learn today. I've learned quite a bit. Thank you. Next slide, please. All right, so now I'd like to introduce Stephanie and then hand it off. Stephanie will hand it off to Delaney, who will be our speakers today.
Thank you, Laurel, so much for that wonderful invitation. Delaney and I are thrilled to be here. More about me, but more storytelling. Just like Laurel said, I'm a partner at Private Vista. Our goal at the firm is to help clients achieve their long-term financial goals and life goals. And how do those things interact and come together? Most importantly, the reason I'm so excited to be here is my passion and why I'm in this field is to educate across the board on finance, more specifically women. So I'm really, really excited to be here. That was a wonderful intro, Laurel. I really appreciate it. And Delaney from my office is also joining us as a panelist.
Hi, my name is Delaney Orozco. I'm an advisor at Private Vista. As Stephanie said, we are so happy and excited to be here and to have the opportunity to sit down and speak with a great group of women. Educating women is one of our passions. For me in particular, I feel like most of my life, I've been trying to go above and beyond and prove myself in very male-dominated fields. For me, it was sports most of my life, and now it's my career in the financial services industry. And being that women have come a long way, it's still very male-dominated, and I feel like this group can really relate to that, being in technology. So our goal for today is to really let you all walk away feeling confident and feeling like you have control over the decisions that we make every day in our finances.
That's awesome, Delaney, and thank you for that point. That is one point that I missed is, yeah, working with a financial firm is a lot like working with ISG, right? We are a small percentage of the folks that they're employed by our firm. So getting that unique perspective, I think, builds a lot of value and a lot of competency for our firms that may not be noticed in the ways they should. So that's something good to keep in mind. So I mentioned that we were going to do a poll, right? And so when we first started talking about how will we build this for women, there were three topics that Stephanie and Delaney suggested: the behavioral finance, why do we do what we do, right? The life events, how do we approach in those different stages of life that we talked about, whether you're coming out of college, starting a family, you're in that sandwich generation where you may have children and a parent living in your home. And we're all in different life stages just in terms of the way that we save and the way we think about money. And then the financial literacy piece of this. So we're going to give you about 30 seconds on this live poll to pick what you think are the two most important topics to you that interest you the most. So please feel free to jump on the screen and pick two. Okay, great. And if we can show the results, Delaney, maybe you can talk a little bit about what you would expect and what we see here.
So these answers always seem to surprise me, Laurel, no matter how many times we ask these questions. So it's funny that life events and financial literacy ended up being the most intriguing topics to this group, because for me, as you already know, Laurel, one of my passions is the psychology behind money. So it's really hard to see where we're going if we don't know where we've been. So we're going to actually kick it off with behavioral finance, which, although seems to be the least favorite topic, I think by the end of it, you will all find it very interesting. So Laurel, why don't you go ahead and give us another poll quiz here?
Great. Yeah, if you can split forward, please, Nicole.
I think that's the answer, Laurel. So maybe we're gonna ask the audience this poll first.
Oh, great, thank you. Yeah, so what percentage of women state that money is their number one source of stress? This was a very interesting question to me because I had to think about how to answer that. So yeah, if you wouldn't mind just as a group answering what you think that answer would be for you and how stress comes into your life with money. I think you're going to learn a lot here. Okay, so if we can see the results.
All right, so Nicole, do you want to hop to the next slide here? So thank you all for your answers. It is clear that this is a smart group of women because you were dead on with your response. So we actually know that 65% of women say that money is their number one source of stress. And that's pretty significant compared to the 52% of men that say it's a trigger of stress for them. So, you know, it's kind of, where do we start to start figuring out why is it such a stress trigger? And there's so many studies out there that show that women are actually more successful investors. So if we're more successful at investing and with the money conversation, why is it that we only end up with 2/3 the amount of money that men have when we retire? So it's kind of, how do we start unpacking that suitcase and figuring out why is that?
Yeah, that's great, Delaney. I think that's one of the things that shocked me is like we have all these significant responsibilities, right? So how do we do that? How do we step into it?
Yeah, so we've noticed that over time, women have truly come into this with more responsibility when we talk about the household finances, or even just when we're still single and trying to make some of those decisions. I would say this slide for me is one of the most staggering statistics. So 90% of men say that their partner or spouse will defer all financial decisions and topics to them. And although that's probably not the most staggering part, 63% of women actually agree with them. So that just goes to show that women don't really want to talk about money. And one of the things I like to bring up about this slide is we know that women have a time constraint. So kind of in society, generally speaking, it has always been the woman that runs the household. So not only are we doing all of the soccer practices, cooking, cleaning, it's kind of like, do we really have time to talk about money? So that's why I love to point out the slide at the top, or the numbers at the top here, because 29% of the women in financial services industry also defer the finance topic to their spouse or their partner. So even women that do the same similar things as Stephanie and I will still defer that. So we want to try to figure out, why is that? Why are women who are clearly even educated on the topic still finding a way to defer the topic? So if you want to pop to the next slide for me, Nicole. So the way we start to unpack this, I love this topic because it's something that I think people kind of start to forget. So by the age of 7, many of your money habits are already starting to form, or even in some cases, they've already set. So I really like this slide, and I'll actually give an anecdote about my life. I'm kind of an open book, as Stephanie can tell you. A lot of times what you'll see is if you're used to a norm, so your mother was the keeper of the house and your father made all the financial decisions, it's pretty easy to fall into that norm. We also see the reverse, which happened in my household. So my mom and I are complete polar opposites when it comes to money. She was a single mother. She made all the decisions, but she lives what we call the YOLO lifestyle. So as money came in the door, she wanted to make sure that she got to spend it right away. She never wanted to feel like if she got hit by the bus tomorrow, she didn't spend all her money. I am on the complete opposite spectrum. I feel like I have to stock away all my money because I never want to be in debt. Neither are right or wrong, but we want to find the balance for everybody that really works with your psychology and how you feel about money. So Nicole, if you want to pop in for me. So how do we start to do that? We have to start by building confidence. That is the key. Once we feel confident about the decisions that we're making, and once we feel educated, everything seems to fall into place. So when we talk about investing, there are 2 emotions that always seem to come into play. So there's fear and there's greed. So when we think about investing as a whole, you'll probably hear this even from Stephanie and I more today. You always want to buy low and sell high. So we always want to buy things on sale, right? That every woman loves a good sale. So the reason why women tend to be better investors is we're much better at following some of these rules. So when once we can remove the fear as our driver, we know that we don't have to time the market because we're not fearful. We're not greedy. We don't have to make sure that we time it in that sense. I really like this statistic here about the S&P 500. A lot of times when you hear people talk about the market, that's usually what they're referring to, even though, as Stephanie will go into later, it's a much broader definition when we talk about the market. So if you had missed the 10 best days, you made 28%. That's not too bad over the lifespan of the S&P. But if you had kind of held steady and really not tried to time anything, you've had over 17,000%. So quite a big difference there.
Yeah, I would agree. And I think, one of the things that was apparent to me is like, how do you decide what to spend, right? So I'm more on the behavioral finance too. And I think everybody's got a personal story about how they grew up. Like my mom's favorite thing to do would be, somebody would give her a compliment and she'd go $5, like she was so proud that she didn't pay what it was worth. So I think I relate to your story there, Delaney. And so when you start to think about these different life stages, and I know we're going to go into that, there's 3 areas that you have on the screen. Can you talk us through what those are? And then we'll get to the next area around the life event piece of it.
Yeah, absolutely. So I think the way that we like to look at this decision tree is, so I've got 5% of my paycheck left. What do I do with that 5%? I've already started to take care of everything in the blue. So everything in the blue is going to be those fixed expenses, things that we really can't avoid. So taxes, housing, food, transportation, those are the things we know we have to pay for. So that's got to be our number 1 priority. Stepping down from that, the next piece, and I know we like to say this a lot in our industry, and you've probably heard this term, pay yourself first. So once I've taken care of my fixed expenses, I know I need to pay myself. So how do I start saving? And how do I start saving for the goals that matter most to me? That's the key there. We really want everyone to think about their goals and what's most important, and how do we start saving for that? The next step there is the debt. So for me, like I was talking about earlier, I was so scared of credit cards because I never wanted to be in credit card debt. Come to find out, they can be a very useful tool when you use them correctly. So how do we start using our money to leverage some things that can help us? And then the final piece is the discretionary spending. So once you've got that 5% left and we've decided what you need to save, what we need to spend on our debt, how much do we spend on things that we enjoy during our life? So going back to my mom, you can still YOLO and still have a great decision tree at the end of the day.
That's great, Delaney. Thank you so much. I appreciate the anecdotal information, because I think when you story tell, like we know as consultants, that's very important in what we do. You got to bring it to life for people so it doesn't make it as scary, right?
Yeah.
So moving into the life event phase of this, right? So what financial decisions should we be making at different stages of our life? So I've given some examples of the way I've lived my life, and some of those things I haven't achieved yet, right? Hopefully I will. But as you think about how you build for that plan, we have another quiz here around what life event is most important to you, right? So for the folks on the phone, just think about, is it the inheritance and financial windfall that you may get? Is it financial independence because you want to retire or retire early? Is it children's events like planning for new births and college and the things that come along with that? So we'll take another 30 seconds here just to look at the responses. Okay, great. Nicole, if you could pop those up, please.
Wow, so interesting.
It is interesting, yeah. Yeah, so Stephanie, as you read this, what are the things that come to light for you, and reading the information from the team we have on the phone, what surprises you?
Yeah, really it doesn't surprise me, because a lot of people work with Delaney and I in order to figure out, can we stop? Meaning, can we retire one day, and what does that look like for us? The inheritance financial windfall, we're going to touch on that briefly because it is also an important topic when we talk about generational wealth. So I think these are all wonderful places to start, because how do you start to accomplish all of each individual goals? As Delaney said, all of us don't match. So some people might say my number 1 goal is to stop at a certain point, meaning working for money and being in a career. Some people don't have that in mind and really are thinking about other things. So Nicole, if you want to pop to the next slide, how we really think about planning your goals is figuring out how to set your goals and make a plan. So these same catchphrases are what you saw a couple slides ago from Delaney on the decision tree, but how do we break them into an actual monetary cost and put them together with smaller bite-sized pieces? So Delaney mentioned these really in a global level, and now we want to think about the next step in kind of creating your own plan is to set those goals. So in the short term, in the midterm, and in the long term, what is the thought process and what are each of your individual goals? So short-term goals are going to be things like credit card debt, possibly purchasing a house or a car, starting to accumulate your emergency savings, and starting small, because really our other way of thinking about it is all of these buckets never go in a silo. So can you, Laurel, be touching on all of these at the same time? That's really the most challenging part in my mind in creating your own plan, because how do you figure out what number goes with each column? That's where the puzzle piece really comes into play. Creating a budget and sticking to it in the short term, that's really key. In the midterm, start to pay off longer term debts, possibly begin those mortgage payments, save for college, save for retirement, and then determine any longer term needs. And then finally, in the long term, that's where it's so interesting that the number one poll answer for us today was retirement, because how do you can't skip over the blue and the green columns to get to the long term in the red column. And that's really the most important part when we talk about making a plan.
Great. So this inheritance is interesting, right? So can you talk a little bit more about that and why you wanted to include that in this presentation?
Yeah, that's a wonderful question. So if we look at this next slide here, this statistic I think is really, really important because we know we're on a group of on the call with a group of women who are still currently working. We're making broad assumptions about your age that you're likely not in your 70s and 80s on this call today. So what I mean by that is, in 68.4 trillion US dollars will transfer to heirs and charity over the next 25 years. So the reason that's important is because possibly, as Delaney said, from a behavioral standpoint side of things, you maybe watched your parents not necessarily have this transfer of wealth because the generation ahead of the baby boomers was really the Great Depression era, who probably didn't have this kind of ability to transfer. It's going to be very different from the generation that's retired now or just retiring, based on businesses selling, home selling, and all those kind of things. So it's something that we can't forget when we're making that plan, when we're working with our family members. That's really why we wanted to bring it up, Laurel, because it is different generation to generation, is really, really so important.
Yeah, and when I first saw this slide, and maybe those of you on the phone were like, oh my goodness, if my parents have that, they didn't tell me. Or, you know, if you think about that transfer of wealth and not seeing that before, it's something to keep our eye on, right? But what do we do if we don't have a windfall? If we are from families where that wasn't something that we can look forward to, or we wouldn't know that we would have it until they're gone, right? How will we go about planning for that?
That's a great question. And the first answer is really, most importantly, to start saving as early and as often as you can. And what we mean by that is saving for all of those different buckets that Delaney just talked about. But you know, that YOLO lifestyle or discretionary spending is so important, because I've had clients also say to me, well, Stephanie, I heard you, so I'm never taking another vacation in life. And that's not realistic. That's not something that's going to be mentally healthy as well. So we want to talk about what is that balancing act from the slide that I showed a couple slides ago. So when you have a birth of a child, or you do need to start caring for your parents because they're not transferring you wealth, how do you think about all of those buckets and really setting that goal? So when we jot down our list of action items that we want to take as a household, or with your partner, or with your children, or with your parents, you know, thinking about those goals with the birth of your child. So we're going to talk a little bit more, as Laurel mentioned at the beginning, on the financial literacy side of things, and what do I really mean when I say start saving as early and as often as you can, because I think those are really key important factors. And then living within your means. That's the other really important part when it comes to saving to get to your retirement goals or the birth of your child goal, caring for your parents. The other really most important factor is, don't forget about your career growth, because as you continue to advance in your career, that is additional income most likely that you wouldn't have seen before, and potentially you fix some of those expenses along the way. So you fixed possibly a mortgage, or you fixed and at some point potentially have had as many children as you might have, so you can plan for those goals a little bit more. So all things to remember when you're thinking about the future, Laurel.
That's great. So for those of you on the phone that don't know what YOLO is, a couple of years ago I didn't. So I'll just tell you, it means you only live once, and having boys who said it all the time, I thought I was the uncool mom. So just for those of the people on the phone that didn't know what that meant, that's what it means. And then as you think about these things, Stephanie, right? I tend to be like a glass half full kind of person, right? So I don't want to think about the negative things that could happen. Even I know like life is a balance, right? So whether we're talking about finance or our families or our children or work-life balance, all of those things are going to have an upside and a downside. So when you start to think about some of the pressures that come on, how do you plan for that in your financial future without being all gloom and doom?
Yeah, it's a great question. And we call this playing defense or defensive planning because, as you said, Laurel, we don't want to go into all these things will no matter what happen, but we want to be prepared in case they do. And so thinking about these as well, how do you set the stage for the what ifs? And there are many tools out there in the universe that can help with some of these different tools. We'll just pick on home damage for a minute. If you own a home or if you rent your home, you're going to have home or renter's insurance to cover anything that might happen that's out of your control. And so those are just examples of why we list these things out as well and make sure that we have a plan in place should something arise kind of in these categories. So, part of your financial plan and the thinking behind, can I retire? Can I cover some of those short and long-term goals is making sure that you also have your defensive strategy in place.
And Stephanie, I think that's a really good point to go back to. A lot of these things that we're talking about could be expected. You might be planning for them, but they may also be very unexpected things that come up. So going back to that decision tree and really taking the time to kind of evolve it. It's going to evolve with you during your lifetime. So when some of these things come up, if you weren't expecting the birth of a child or if you weren't expecting home damage, now you have the time to go back through that decision tree.
Yeah. I think that's a really excellent point, Delaney, that we as advisors, Delaney and I, work with clients to do this at least on an annual basis, if not more often. And a lot of times this is your general checkup, as Delaney said. You can check up on your own personal goals, you can check up on where you are, but sometimes things change. Not sometimes, this is life, oftentimes things change. The other way that we look at this, as well as Delaney said, is to focus yourself and go from what we call the 8-lane highway. Even writing up that goal or that plan narrows your highway down to hopefully 2. You're never going to be on a straight and narrow 1-lane highway. That's not how life works. We're all aware of that. There will be some swerving and some adjusting to be had, but that's why, as Delaney said, you put that plan in place.
Yeah, I think that's great. I mean, obviously when people get married, they don't anticipate divorce, and that could happen, right? Or if you're living in an area where home damage can occur, or you get in a car wreck that you didn't plan on, like all those things are not something we want to look forward to, but that are going to happen. So I think it's important that you bring that up, because if you don't build that into your financial plan, then you're short-sighted. So thank you for that explanation. So we have one more quiz here around the financial literacy part of this. So the part that has always been, for me personally, the difficult area of, I don't want to think about it, I don't want to deal with it, because now we're taking that decision tree and really breaking it down to what can I do to make informed decisions. So our last quiz is around if you start saving, what does it look like, right? If you start saving now, then, or 5 years from now, what is the difference in the money that you'll save and make? And so interested in the answers on this as well. So we'll give you 30 seconds to think about what you think that might be. Okay, I think that's about 30 seconds. We can show the results on this. We got some smart women on the phone, a lot smarter than I was when I took this the first time.
We do. And I love explaining this answer too, Laurel, because if you think about 5 years over 4 years, that's really what we were trying to say here, which is if I started saving in 5 years instead of today, and then save for the rest of my career, save for 40 years, that's really only saving 12% less of the time. If you took 5 years away from 40 years, that's it. So the answer is actually that you are, your account balance is going to be 40% less. So as Laurel says, that's amazing to us when we look at that math. So if we go over to the next slide, I think the really, really important part here is, how is that possible? You know, when we say that all the time, and if we look at the statistics here, so this is an example of someone, you know, starting to save $5,000 a year and assuming a 10% rate of return. We're going to talk about next about how that's not always going to be 10% equally, but for the illustrative purposes, when we look here, what happens is you can see that person who started 5 years later on that black line. Why that occurs is because the very first dollars you invest continue to compound and grow upon themselves through that entire career. So it really does make a difference of starting that early and often, as I mentioned before. And this really ties back to the beginning of our conversation, which is wanting everyone to feel empowered and comfortable enough to start investing. So whatever it is that you're empowering yourself on decisions that you make, if it's you know, figuring out to pay off debt first, what's the balancing act again of just starting something small? So these numbers are a little bit staggering when you think about it's $5,000 a year, that the person in blue actually has $2.4 million versus 1.4. So really, really awesome statistics.
So Stephanie, as I think about that, right? I luckily was pushed in the back by some women leaders I had early on telling me to save in my 401k, right? I didn't know what that meant at the time. I'm glad I listened to them. So I had that opportunity. What would you suggest for people that may not have been pushed in the back that way, or how do people start that financial journey?
Yeah, I think, again, it's so important, Laurel, that we educate first as to what is out there in the universe, because to me, that's the scariest part. Well, okay, you're telling me to invest, but what the heck do I do that? So we're going to take a little quick slide here in terms of what types of investments are really out there in the universe, so that you're able to help narrow that down for yourself. So, you know, one type of investment out there in the universe might be what you might have in your checking or savings account. So that red column, what we call your cash equivalents. These have very, very little risk because of the fact that they're in a cash equivalent, but they're not going to keep up with inflation in the future. So if we think about what we go ask your parents or your grandparents or great aunts or uncles what they spent to buy a gallon of milk, or what a stamp cost 20 years ago, we know that inflation is real and exists. And if you left your money in cash, getting prepared for a goal such as retirement or college or buying a home that's, you know, maybe 5 or 10 years down the road, it's possible that your cash doesn't keep up with inflation. Possible. The next one, Laurel, that always I think is the most confusing is the bond market and how to purchase and what is a bond in the first place. What does that really mean for my portfolio? A bond is actually a loan to a government or a corporation. Today in society, how bonds work is that you have a bond fund unless you are an institutional investor. And what that means is investors that are buying in the millions and millions of US dollars size-wise. So generally, most individual investors are going to buy bond funds, which is a bucket of bonds. When we say a loan to a government or corporation, we all assume that if I loan Delaney money, what would I expect in return? I would expect her to pay me back my money, and I would expect interest. Those are the two big things we would expect in return. That's how bonds of old, meaning, again, go back generations, a couple generations ago, you could walk into a bank and say, I would like to purchase a bond for $10,000 for whatever city you might live in or any other city that offered a bond. And they would hold your money for $10,000, give you interest on a regular basis, and give you back your money at the end of the term. Today, bonds work in such way that that's still occurring, but because they're bought and sold on a bond market, what that means is every time interest rates rise, and we're starting to see that a little bit more, your bond principal can be negative because of the fact that your more bonds coming onto the marketplace are paying higher interest. So when a bond is paying higher interest, the bonds that you currently own might need to be sold at a discount. So bonds are very interesting to us because they will be less volatile than stocks. So let's jump right to that, and then I'll tie the two together. So when we look at that blue column, oh, sorry, jump back a slide for me. When we look at this blue column on stocks, stocks are actually ownership in any publicly traded company. So if I buy a share of a stock, I expect when that company does well, the stock price will go up. And when that company doesn't do as well, that stock price will go down. In addition, sometimes you can have a little dividend that's paid. So that's a little gift of a couple of a percentage points of a stock that would be added to your portfolio. That's why when we were back a few slides ago, that power of compounding or that growth over time is so important because you already own shares that are continuing to be added to. Tying these two together though, stocks will be more volatile than the bond market. So what I don't want people to walk away with is, yes, bonds can lose money as well. That's true. But stocks, generally speaking, when we look at history, are going to have a bigger volatility over time. Now, what's that other column right there? That gray column on the right. That is really what we call other stuff, meaning that the big three, when we think about investing or putting money into a workplace retirement account, or buying mutual funds, you're going to buy cash or bonds or stocks. The other stuff is a specialty area. So could you outside be investing in real estate? Are there actually real estate funds? Could you be buying money in currencies or derivatives or managed futures? So things that are not necessarily buying the stock of a company and holding it, or buying a bond of a corporation or a municipality. So that's really what the other stuff means. I know that's probably the most boring part of our conversation today, but we think it's so important that everyone understands really the types of investments out there before you could make a decision.
I'm going to raise my hand and jump in and say it's not boring. I've learned a lot through this because I always thought bonds were safe, but you didn't get any money out of them. And stocks were volatile, so you chased, a lot of the things you see trending. Okay, well, we're going to get Bitcoin, or we're going to, and then you see, somebody became a millionaire in one day and they spent $1,000. Like the likelihood of that is pretty low, and you have to know the market, I would assume. But then the other category is interesting too, because it helps you think about investing in a different way that might not be as scary for you, right? So I wouldn't say it's boring. I think it's incredibly educational.
Yeah.
So how do we start thinking about like the risk and reward of that? Is there any advice on that?
Yeah, and I'll actually hop in here a little because I love what you just said about picking one thing that's done great. So when we think about investing, there's really two things to think about. The products that we're picking, so the types of investments like Stephanie just went through, and then actually the allocation, so how much we're assigning to each of those things. So if you think of your asset allocation as a big pie, all of those things can be slotted as pieces of your pie. So the real question is, where do we want the diversity? And it's going to be different for everyone. So it's always important to talk to a financial advisor when trying to think about this. But we really want to make sure that every piece of your pie is diverse and you've got the right amount allocated to each. So it's not so much, hey, did I get really, really lucky on that one stock? But your returns can be driven from that asset allocation. And the more aggressive your allocation, the riskier it is. You may have more reward over the long term, but depending on where you are in your career, that may or may not be necessary to take on that amount of risk to achieve the goals you're trying to achieve.
So
Makes perfect sense.
Yeah, tying that all back to what Delaney said, our number one goal is helping empower people to make decisions that they understand the impact. Because I think, Laura, like you said, there is, or maybe Delaney said it, there is no really right or wrong answer. It's what's the impact on your long-term life and accomplishing your goals. So, as Delaney mentioned, or Laurel, you did, some people might enjoy the kind of the chase of the riskier stock or things like that. That may not be for everyone. Their goal might be something that we think is unrelated to finance, but really isn't. Is it retirement first? Is it paying for college? Is it getting rid of debts? Those sound like they're related to finance, but then accomplishing those lifelong goals, is it traveling with a family because you are retired and could do that earlier than you thought? Those kind of conversations.
No, I really appreciate it. I think it's helped ground me. Like everybody has a different favorite color, right? So just because your favorite color might be yellow and mine might be green, because that's what I'm wearing today, it doesn't mean that we all can't like plan for that in different ways where we plan for what's important in our life. So for me, I sure appreciate all the things that Private Vista has done. We're going to go into the Q&A portion of this now, but before we do that, I also want to tell the group on the phone, the Women in Digital team, that Private Vista has put together a financial guidebook and a landing page where you're going to be able to contact them. So once we have 2 sessions today, we have this morning session and we have one this afternoon. After that, you will get a follow-up. So if you want to contact Stephanie or Delaney directly, or you want more information on this, we'll send the presentation out, but the landing page really can help you kind of take that journey. And if there's anything you all want to add there, please feel free to do that.
Yeah, I think it's just adding on to what you said, Laurel, that the guidebook is so cool because it's a way for you to jot these questions down. So when Delaney went through the decision tree and then we talked about our goals, one of the biggest things that we get asked is like, where do I even start? And it's not that scary when you download that packet, because it asks you questions that you probably know the answer to, or if you just took 5 or 10 minutes, you probably do at that point. So it's really not that scary, but it gives you a starting place as to where to start to bring your roadmap together.
Well, you've definitely made it less scary. So I appreciate that. So from the audience, we're going to open it up now. And I think you can raise your hand and ask a question. Yeah. Interested in the feedback from the teams.
We're really interested, and also as Laurel mentioned, you can also email me right now. I'm going to keep my email open to watch for any emails. Forgive us, but the compliance side of our industry doesn't allow the chat feature to be turned on or Q&A. So that's why we have to go the route of raise the hand and open the mic up, or you can certainly email me so that I can read the question out loud. So I'm not seeing any in my email yet, but I'm continuing to watch. And I'm not sure if we have any hands raised. Nicole Young might be able to tell us. That's our person behind the scenes helping us today. So we appreciate that.
We don't have any yet. Oh, we have one hand raised, Susan Jones. So I will go ahead and unmute Susan Jones if you want to ask your question.
I think you might be muted, Susan, if you want to unmute.
Is that better? Yep. There we go. Sorry about that. Thank you, first of all, for your time this morning. The slide that really was interesting to me, all of it was, but one that really sticks with me is that 5-year difference. But it's a little disheartening as well, because if you think about, oh, well, it's been more than 5 years. So it may go back to what you were saying about, where to start. But, in some cases, it may be longer than 5 years. And really, can you still get a foothold if you've waited longer?
That's a good question. Delaney and I get that all the time as well. We strongly believe that you can, because every little bit helps. Because even if you think about that chart, yes, we showed a big dramatic spread at the end there, but if you think of it, there still is absolutely a spread at 10 years, at the 5-year mark. And so we always encourage people that it's not time to look backwards, but to look forward and make the plan now, because it's absolutely something that you can accomplish your goals when you make a plan.
Right. Well, thank you for the follow-ups and the plan that you said you were going to make available.
Yeah, you're very welcome. Thank you for joining us. Nicole, I thought I saw another hand, but then I think it went away.
Yeah, I think we had, it was Padma who possibly had their hand up. If you'd like to raise it again, yes, it is back up. So I'll give you permission right now to unmute if you'd like to ask the panel your question.
I can see Padma's mic moving, but I don't hear anything. Laurel or Delaney, do you hear anything?
Mm-mm. Now, Padma, are you speaking?
Can you hear me now?
Yes. Yes.
Sorry. Sorry, I had a new laptop today, so I'm sorry. I'm still setting up that. So the question I had more was, thanks for the session, firstly. I mean, my answers were actually matching all the higher percentages, but I was just worried to see, I mean, out of the blue in the decision tree, in the blue fixes, I mean, all the stuff, as women, we tend to get remove our stress by doing a lot of shopping, which is actually not necessary, but I think we spend a lot of money there. At least as we Indians really use that as a stress busters. If we are angry on our spouses, we just go pick our purse, we land up into a shop and spend. So how do we ensure that we doesn't do that and actually take care of the stress that we actually wanted to go?
That's a great question. Delaney, do you want to
Yeah. So I think that the best way to start is to write out a budget. So even if you don't like the idea of sitting down and tracking every dollar that you spend, just getting it on paper really starts the process. I think that that's the most important piece is starting somewhere to have a cognizant approach to it. Because if we never sit down and actually think about it, we kind of just continue to go on our everyday life. And then we're not saving maybe what we could or spending what we could or what we should. So I think it's having it be top of mind at some point to get started.
And just to add on to that, I think the other one is make it realistic, like Delaney said, because there's no reason to cut that out completely. And that's never all about the balance. So figuring out that balancing of, you know, what is an appropriate amount for me to spend every month? And if I already went 2 weeks ago, should I make sure that I either split that up over the month to prepare for what could be happening in a few weeks when I'm shopping? And as Delaney said, that's really the important part for us. Just, you know, thinking about it on a, and as Delaney said, some people like to do this on an annual basis. Some people like to do it on a monthly basis. There's no right or wrong answer because maybe you only do all of your shopping at 2 times a year, you know, once in summer and once at the holidays, and that's it. So there's no right answer. It's really more about jotting it down and trying to stick with it.
It depends on how much you fight with your spouse.
Right.
No.
Yeah, that's true. And at what age we are with them. So
The non-financial person in the group. Yeah.
thank you so much.
You're welcome. Looks like Nicole, can you open Lucy's microphone for us?
Sure thing. Lucy, you are unmuted.
Excellent. Hopefully you can hear me okay.
Yep.
Yes, thank you.
Perfect. Thank you. Yeah, really interesting presentation. I just wondered, I'm based in the UK and I wondered if your stats that you shared in the presentation, are they focused on the US or are they more global?
They are a little bit more US based in terms of generational wealth, but the statistics of saving 5,000 a year, we just have to put in like a marker, but you could change that to pounds or euros, and that would still hold true. So the markets of where you invest internationally and how stocks work all hold true globally.
Yeah.
So I think that's really important.
Okay,
Great
cool.
question. You're welcome. And Nicole, can you open up Kimberly for us?
No problem. Kimberly, you should be unmuted.
Good morning. Can you guys
Morning.
hear me?
Yes.
So thank you so much. This is such a great presentation. And I appreciate all the hard work that goes into this, Laurel. So thank you. And thank you, Kara, because I know she did a lot to get this going as well. Could you explain how you use, you know, a financial advisor? And you know, I know this probably feels a little self-serving, but I really am interested in understanding, how do you leverage a financial advisor? How do you leverage a broker? Should you also have an attorney in that mix, you know, as you think about your money and maybe your inheritance and stuff like that?
Yeah.
Actually, I'll hop in here, Stephanie, because I really do like this question, because a lot of times what you'll hear is, well, a financial advisor, there's 40 different kinds of financial advisors. So what Stephanie and I always like to point out is, once you get to a point to where doing it yourself starts to get a little more complex. So when your personal situation is, you've got enough to reach out and get some help, we would suggest looking for someone who acts as a fiduciary. So that's always kind of my number one recommendation when starting to reach out to financial advisors. So for everyone on the call, it's important to know the difference between fiduciary and suitability. So fiduciary means that someone has to act in the best interest for their client. And you would think, why wouldn't everyone do that? But there is another piece to the industry called suitability, which means someone just has to do what's suitable for the client. So when you are starting to reach out to an advisor, I don't know if you necessarily need a certain type of attorney to be in there, but you want to look for someone who acts as a fiduciary, who will then start to bring you in and say, okay, here's a great strategy for an accountant you might need. Here's a great strategy for an estate planning attorney you might need. Because there starts to be more pieces to the puzzle that the financial advisor can really quarterback. And I think that that's the main piece to why you would want to start looking for one and who they can get you in touch with.
So just to add on to that, Kimberly, I think the other way of continuing that conversation is Delaney and I at Private Vista look at planning first and then implementing, as Delaney said, as the team coordinator. And so the client team coordinator. So when, many people at some point will need an accountant, and that's usually a recommendation that goes along with that. The difference between broker and planner. So Delaney and I actually also act as investment advisors. The broker world is more like, personally, we just don't use it anymore because it gives a sense of like constantly buying and selling things, which is not wrong or right. Technically, I guess we fall in that category as investment advisors, Kimberly. Those are more synonyms and planners are separate. So when we do planning first, we then implement the investment side with our clients and act as the investment advisor. You can find certainly financial planners who do their planning only and don't invest money for clients. Those exist out there. A lot of us overlap in those two categories. Things that we're not, though, are accountants and attorneys. That's not our specialty. We don't want those jobs. But as Delaney said, to help, you always want your financial planner or advisor coordinating with those two people. That's really the most important part to answer your question, because they do tie together. So you want to make sure your accountant knows what's going on in terms of what income you have, but also what investments you might have or what your plan is. So I don't know if they answer your question, Kimberly.
Yeah, that was great. Thank you very much. I appreciate that.
I just have a follow-up question to Kimberly's, because that's one I wanted to ask. I just don't want to take all the time. Is how, so when people are getting started, right, we're looking at that 5-year journey. Do you start with, and I'm sure you're going to say yes because you're financial advisors, but do you start with the attorney? Do you start with the accountant? Do you start, like, how do people step into this in a way that they can be confident? Because most people don't reach out to an attorney until they need one, right?
Yeah.
So is that a service that we could expect from a financial advisor? They would have an attorney, or they would have somebody that you could reach out to, or do you typically work with private attorneys, or how does that whole process?
It's a great question. We personally, as you said, Laurel, it's right, wrong, or indifferent. We love starting the process with a plan as financial planners, but that's not how it always works. Somehow, some reason, somebody might meet an attorney because, again, their parents are going through something, generational wealth, and the attorney says, hey, you really should get a financial planner. It's time because you have this much stuff going on. Accountants will sometimes see things on your own taxes when they file those that might say a little flag to them, or a little trigger that says, hey, are you getting help with all these other items on your return? So we start with a plan, but that is absolutely not how life works. Again, we get referrals from many places and we work independently to bring together a whole team for everyone. So
awesome. Thank you.
Sure. I'm just going to check my email one more time, Laurel, and see if anyone emailed questions, but I don't see any. So I know we're coming close to the end, close to 10 o'clock Eastern time.
We are. And again, thank you all for the time. And the folks on the phone, you will be receiving the packet. The contact information will be in that. You'll also be able to link to them directly. So thank you so much, Stephanie and Delaney and Nicole and team, for all the hard work that you've done for this. I know I've been educated. I know a lot of folks on the phone have been. I'd love seeing all the answers, because when we went through our test group and I did my answer, and then you see the staggering differences in the way we all are, I think it really stands up for what Women in Digital is all about. We're all different. We all have a different journey that we're on. We're all in different places in the world and we have different goals. So So just appreciate you all helping us on this journey, and look forward to talking to you soon. Thank you for the time.
Thank you so much for having us, and everyone on your team for organizing it. It's been wonderful to be able to talk with the team.
It has. Thank you.
Thank you.
All right.